at Dalton Capital Advisors joins us on the show right now. Mr. Bhat, thanks very much for taking out the time. What are you making out of the current market setup? More focused right now on what the currency has been doing, as well as a few other macro pressure points that the government is trying to tackle right now. Were you at all enthused by some of the announcements that came over the weekend?
Well, I think enthused to the extent that the government took notice of this. But I think the measures were very, very half-hearted. I mean, they really don't address the issue to any significant extent. But I think the fact that the government is closely watching this and probably will come out with more measures if required, I think that's a good sign. So therefore, to that extent, I think that's all we have to give credence to those measures. But otherwise, I think even the rupee is not terribly out of kilter with the REER now. So therefore, there is no fundamental reason for it to depreciate dramatically from here. So I think it will find support somewhere, 72, 73 levels. And unless there is further pickup in oil prices or something like that, I think it should sort of stabilize around these levels.
Do you think that this is just probably an over-exaggerated sell-off in the currency in respect to the emerging market currency sell-off, or this is fair?
I think, in the interest of our trade balance, I think we should have the rupee at somewhere near REER, and I think it is there. I mean, it was terribly out of kilter with REER for quite some time now, and that this depreciation has brought it somewhere there. And I
72,
think
73 is
where it is, and I think even the RBI should be concerned that it can. I mean, exports have to increase, means you have to have it somewhere near REER, and I think it is there. So therefore, I don't think there will be too much of a pressure from a fundamental viewpoint, but technically there could certainly be, if tomorrow oil prices go up by another couple of dollars, I think there may be further pressure, but not otherwise.
Interesting. Mr. Bhat, what does all of this do to the market valuations? Sure, the micro is working, but can a strong micro withstand the volatility that stems because of a busy political calendar over the course of the next 3-4 months, not just locally but globally as well? And to these macro stress that we're talking about, would a par for the course move take the Nifty way lower than where we are right now?
I think possible, because if you really see, inflation is under reasonable control, and even the fisc seems to be in reasonable control. It's only the export front we have, on the balance of payments problems we have. Export has, of course, August has been quite good, but otherwise, generally this year, exports have not been all that good. But I think it's more of the international situation that is really causing us problems. The continuing trade war, and I think probably it's going up one notch again. That plus you have situation in Iran.
Competition all through. I mean, we're talking to a few international brokerages as well, Mr. Bhat, and everybody believe that if the trade war takes the center stage of investor opinion across the world, then India is actually in a sweeter spot because of the intrinsically domestic-oriented economy.
Yeah, that I think in the medium term that is certainly the case. But in the short term, volatility will be there, and India will not remain immune to that. That is one. But again, as you said, even domestically, the only concern is the emerging election calendar, and that is something that I think will be keenly watched, especially because the ruling party may not really be able to hold on to quite a few of these states. So therefore, I think that is something that's a cause of worry as far as the market is concerned.
So do you think that will start getting priced in the run-up to the elections? Because everybody right now believes that in none of the 3 states there will be a major impact that the ruling party could have. So is that already priced in? Does the market start pricing in it in the run-up to the elections, or do you think there will be an aftershock if the numbers were not that great for the ruling party in the state elections?
Of course, there will be an aftershock if the numbers are not very good. But I think initially we should really see some initial opinion polls. We really have not had opinion polls of any significant results. So therefore, I think the first opinion polls will sort of set direction as far as the market opinion is concerned. But as of now, the base case is that they will probably scrape through. So therefore, that is something that that could be questioned with the opinion polls. And then I think because of that, if it is something different than what the base case, then there could be certain volatility in the market.
In the current environment, while we're looking at the near-term volatility, would you deploy fresh money? Would you recommend deploying fresh money? Or there will be significantly attractive valuations that you will find once this storm sort of subsides, what's happening around the world? So you could wait it out.
I think it's worthwhile waiting it out because the storm has just started. It's not really blown over. So I think the trade war is, I think, probably going to increase the temperature for some time, and that is probably that will probably take the market down a bit. Plus also the uncertainty about state elections, where it is not as if the market opinion will finally be with the truth. So therefore, I think there will be uncertainty on account of that, and I think you will find better opportunities as far as the market is concerned. And even then, if you really see, the market has really been supported by 10 stocks maybe. So there are so many other stocks which are really at probably historic lows, and they lost 20-30% quite easily for the last few weeks. So therefore there might be value at some time, but I think we can probably wait it out.
A Nifty PE valuation of 19.3, is it looking stretched to you?
Yeah, I think it's the top end of the valuation band, given the earnings growth that we have seen over the last three years. But every year analysts think that there's a delta there, a dramatic change. They all start with 20% plus and then tone it down to single digits. So therefore we are probably in that same phase now. But I think it will probably mid-teens this year, the earnings growth. So that I think if that is likely to be the outcome, then probably Nifty has some valuation correction possibilities.
Yeah, because the valuations are still one standard deviation away from mean.
Yes, indeed.
Talking about specific sectors and pockets of value that you find right now.
Well, if you have to be in equities and if you have to find value, I think the ones which are really growing, despite all this talk about the trade wars and all that, basically it is non-public sector financials, autos, industrials. These are the ones that really offer you sort of pockets of investable universe. But otherwise, as I said, there is no great reason for you to be invested in equities.
Wow, no great reason to be invested in equities. In which case, let me ask you, some of the consumer discretionary names have come off a little bit. Yeah. A Titan from 1,000 to about 820. HULs of the world have corrected a little bit. Staples as well have corrected a bit. Yeah. So discretionary stroke staples, if you had them in your portfolio, would you go to the extent of selling them out and waiting for lower valuations?
No, I don't think it's worth selling them because they are favorites of the market, and they continue to show some reasonable growth despite all the talk of problems in the economy. But I think so therefore they have to be persisted with. But if there is a correction, a small correction possible, and you can add to it. But I don't think there's a case for you to sell and wait for a correction and buy, because these are all-round favorites of the market. So one should be invested here.
Interesting. The retail-focused private sector banks, and I'm only talking about the top draw, which is the HDFC Bank, Kotak Bank. I'll admit an IndusInd and a Yes Bank too. IndusInd, of course, naturally funds it way, but a Yes Bank too. These four names, off the boil in the last 3 months, they've not really had a remarkable up move. Yeah. Does this price correction extend itself, and would then they become a buying candidate, or would you be comfortable investing fresh surplus here?
Well, I think if you are really gung-ho about this space, which I think the market is, and I think there's a good case for on to be invested here. But a price correction can even affect these stocks, and so therefore you could add to that. But there is no, these are the pockets where I think certainly money has to be invested, because this is where these are the ones who will gain market share with the problems that the public sector banks have, and that will continue for some time, probably a couple of years. So there is a lot of significant growth coming there.
But you will wait it out?
I think you can wait it out. If you're already invested, you should be there. But if you want to buy afresh, there might be a better price points for you to enter.
Just want your opinion now as we step into Q2, once we'll start getting the numbers out. What is your expectation on whether last quarter's performance sees a carry through into this quarter's performance, and will you have the same surprises that came about as last time?
Well, I think the performance will steadily improve. The ones that we talked about which sectors are investment worthy, they will continue to show reasonable growth. But the ones that are not done well, like say for example the public sector banks and the like, they will continue to have significant problems. So it will be a highly polarized market as far as performance is concerned. The ones which have been doing well will continue to do well, and the ones who had problems will continue to have problems. That's the way I think we should look at this market.
For oil and gas, with obviously right now crude oil prices have come off a bit, but there is an expectation that crude oil will cross that $80 per barrel mark, and you will see it sustain at those higher levels once the Iran sanctions come in. Do you see that weighing down heavy on market sentiment, and in particular the oil and gas basket as a whole?
Well, that I think would continue to, because there is if you see past track record, at some stage the government intervenes, whether it is in terms of the downstream or the upstream. So therefore, I think one has to. I mean, we are at the sort of limit of tolerance of the government. So if the government continues to pass on all price increases, allow the PSUs to pass on price increases, then I think it's not a bad thing. But at some stage, I think they will probably pull the plug sometime.
Do you think it's a possibility that they may ask ONGC once again to start sharing subsidy, because they've denied it so far?
They've denied it, but at $90 they may not talk the same language. At $78 they may.
Yeah, but well, thus far you got to give credit on one part for sure, that nowhere has there in the realms of possibilities mentioned that this will happen. It's just the market conjecture that because it's happened in the past, it will happen again. Thus far they really haven't done that. Last question from mine, at least, Mr. Bhat, and that's on some of these beaten down pockets and really tiny tunes which are moving up. So we've now had sugar, and because of a change done in the policy last week, having a meaningful up move. So really beaten down space moving up. Those cable companies, the Den Networks, Hathaways, extremely beaten down pockets moving up as well. That's been the trend the last 1 week at least. Do you find merit in some of the really beaten down names? Because you mentioned a clutch of names are trading close to their 52-week lows or life lows.
Well, I think where there's a policy change, like what you said about sugar, where there's a policy, the possibility.
Sugar?
No, I'm saying there's a policy change. It has already been priced in by the market. I don't know whether there's a huge up move from here. But I think the market acknowledges that there's some policy initiatives need to be priced in, and that they have done that. I don't see that there is a dramatic change in their fortunes, but there will be certainly some change which is priced in. I think the market is very efficient in pricing these policy changes. But so therefore, just because they have been beaten down, I don't know whether they will bounce back, because there has got to be some other impetus for them to bounce back.
Right. Just one question with regards to what's been happening in terms of the market liquidity right now. I mean, while we are seeing, month on month mutual fund investments increasing, there are a few pockets which are actually seeing some amount of strain. Do you believe that this liquidity, there will be a strain on liquidity going forward, or we are pretty sorted on that front?
Well, I think the last month the results are not all that good in terms of mutual fund flows. So I think it all depends on the sentiment in the market, and if the pink press and the media keep talking about an impending correction, retail investors get affected by that. So that is what you saw in the inflows in August. But if they don't make the headlines, the bearishness doesn't make the headlines, then I think it should continue to show this $1 billion plus sort of inflows to the mutual funds every month, and that will sort of keep the sort of outflows that we've seen from FPIs under reasonable. I mean, the market can sustain these sort of outflows as long as the mutual fund inflows are of this order. But if the bearishness continues, you don't know. It might also change.
All right, we'll leave it at that, Mr. Bhat. Thank you so very much for joining us and sharing your views with us on the show.